Take a look at this chart. Have you always wanted to find an indicator that predicts recession without false signals and has been battle tested for many business cycles? This is arguably the most important and the most accurate indicator when it comes to predicting recessions. Shaded areas are the US recessions, and this indicator has increased significantly before every recession since 1948. Can you visually find any false signals? No, because there were none of them. This is the chart of the official unemployment rate in the US. Hi everyone, my name is Ruben, and today we will look at various labor indicators that hint to us that serious cracks are opening up in the US economy. A few days ago, when the markets crashed because of the unwind in the yen car trade and hotter than expected labor data, a lot of people got scared of a potential recession and panic sold their assets. This can be evidenced by the searches for the term recession, which skyrocketed on the 2nd of August. As always, investors became more attentive only when something broke in the economy. Most of the panic sellers who were scared of a recession a few days ago are now bullish again, as their assets somewhat recovered. Do not let your emotions rule your investment decisions. Being rational and data-driven has become so rare nowadays that it can literally become your edge in the markets. And that's what we are doing in this series. We have covered household and business indicators in the first two parts of this series, which you can find in the description of this video. In part 3, we will concentrate on the labor indicators that have a high success rate of predicting economic downturns. Let's get started. Here is the chart we saw in this video's opening scene. It's the official unemployment rate in the US. As you might know, a technical recession occurs when there is a negative growth of the real GDP for 2 consecutive quarters. The United States and many other economies experienced a technical recession in 2022. However, it was not declared as an official one. The reason is that official recessions are declared by the National Bureau of Economic Research, and the growth rate of the real GDP is not the only factor they are looking at. One of the most important factors is the unemployment rate. As can be seen from this chart, the unemployment rate has increased substantially before every recession since 1948. If we look at the current rate closely, we will see that it bottomed in early 2023 and started to increase ever since. It bottomed at 3.4% in April of 2023 and now sits at 4.3%. This is a 26% increase in only 15 months. The question is whether this increase is significant, and if yes, then what is the accuracy of this indicator when it comes to predicting recessions? The answer to the first question is that this increase is significant because whenever there was an increase of 26% in the unemployment rate, a recession followed. Put simply, there was no instance when the unemployment rate surged by 26% and the recession didn't materialize. When it comes to the accuracy of this indicator as a recession predictor, it is undoubtedly one of the best leading indicators. The number of true positives is 12. In simple terms, it means that there have been 12 recessions in the US since 1948, and this indicator predicted all of those, meaning that it went up significantly before and during recessions. But the most impressive thing about this indicator is that it has no false positives or false negatives. False positives are the instances when the indicator predicted a recession that didn't materialize. And false negatives are the instances when the indicator predicted no recession, but a recession materialized. Those are the errors of the indicators, specifically type 1 and type 2 errors. And this indicator impressively had none of those errors. As we have the numbers for true positives, false positives, and false negatives, we can proceed to calculate the performance measures for the unemployment rate indicator. The results are staggering. All 3 indicators, the precision, recall, and F1 score are 100%. This is because there are no false positives and false negatives. The performance measures of the unemployment rate make it one of the best, if not the best indicator when it comes to predicting a recession. That's why saying that there will be no recession in 2024 means betting against this indicator. Let me remind you that this indicator has 100% accuracy and no errors for the last 75 years and 12 recessions. To say that there will be no recession in this business cycle is to say that this time is different, the most dangerous forwards in the world of investing. It can certainly happen, but the odds are heavily against you. Another interesting indicator based on the US unemployment rate is the relationship between the unemployment rate and its 24-month simple moving average. As can be seen on this chart, the unemployment rate surged and the recession followed every time when the unemployment rate was higher than its 24-month moving average. There was only one instance of false positive, which happened in 1967, when the unemployment rate went higher than its 24-month moving average, but a recession didn't follow. If we close up to that year, we will see that the differential between these two charts was close to 4%, and it was temporary, meaning that the unemployment rate went below its 24-month moving average in a few months. Now let's draw our attention to today's situation. The unemployment rate went above its 24-month moving average in the second half of 2023, and these two charts diverged substantially. The result is that the difference between these two charts is now about 16%, which is very significant. Bear in mind that if the Fed is to engineer a soft landing, this will be the first time when the unemployment rate is higher than its 24-month moving average by a whopping 16% and the recession doesn't materialize. You wouldn't bet on it, would you? Another derivative indicator, which is again based on the unemployment rate and its moving average, is the famous or rather infamous Sahm Rule recession indicator. This indicator went above the threshold level of 0.5% during and before recessions for the last 75 years. After the unemployment rate came in at 4.3%, this indicator flashed higher than 0.5%, indicating a recession. This indicator appeared in many headlines after the unwind of the yen carry trade on the 5th of August, when some investors started to price in a recession in the US. So what is this indicator and how does it work? It's an economic indicator created by Claudia Sahm, which signals a recession when the 3-month moving average of the US unemployment rate is half a percentage point or more above the lowest point of the 3-month moving average of the unemployment rate over the past year. Although this indicator was created for identifying the early stages of a recession and provide stimulus checks to households, it has become one of the most accurate and simple recession indicators. There are two main concerns of the Sahm Rule indicator, however. Firstly, it was created in 2019 and the results could be overfitted, meaning that it has good accuracy for the past recessions, but may fail to be a good indicator for the upcoming ones. Secondly, it is usually not a leading indicator. It's a lagging or coincident indicator at best. When it comes to the recent buzz around this indicator, the reason was that it got triggered when the unemployment rate of July came in at 4.3%. Now, all eyes are on the unemployment rate of August, which will be released on the 6th of September. It is yet to be seen whether this was a real signal or a fluke. In plain English, if it triggers again in September, it would imply a higher probability of a recession and potential provision of stimulus checks to households. Keep your eyes peeled for the next labor data. Next, let's look at another crucial set of indicators, the jobless claims. We differentiate two types, initial and continuous. Initial jobless claims comprises people who file to receive unemployment benefits for the first time, whereas continuous claims consist of unemployed people who have already been receiving unemployment benefits. Although both types of jobless claims are used in assessing the macroeconomic outlook, investors tend to rely more on initial jobless claims, which makes perfect sense. Here is the chart of the initial jobless claims and the unemployment rate. As can be seen, initial claims usually lead the unemployment rate, which makes it a great recession indicator. Closing up on the current environment, we see that initial claims act more as a coincident indicator rather than a leading one for the recent quarters. but the significant increase in both indicators doesn't suggest anything good. By looking at the historical performance of this indicator, we will notice that there were only two instances when this indicator surged by more than 20% and the recession didn't follow. The increase over the 2022 lows was close to 34% in July of this year. However, it retraced to 24% in August. Make no mistake, the 24% increase is still significant, and it still suggests that the labor market is not strong in the US. Moving on to the continuous jobless claims, we see that similar to the initial jobless claims, it usually increases substantially before recessions. Visually, there seem to be no big errors for this indicator. Mathematically speaking, the highest increase of this indicator, which was not accompanied by a recession, was only 16%. To reiterate, every time continuous claims went up by more than 16%, a recession followed. Closing up to the current situation, we will notice that the continuous claims increased from 1.4 million in 2022 to around 1.9 million in 2024, which constitutes an increase of 40%. This is another significant surge that is currently not fully priced in by investors. For the next indicator, we have total non-farm job openings. Unfortunately, the data backs to only 2001 and we have only a few business cycles in this chart. Fortunately, we have a clear pattern of job openings for all business cycles. It goes up when everything is fine and it goes down before economic contractions. The best part is that this is a leading indicator that starts to hint to us about a potential recession very early. Total non-farm job openings decreased by 40% during the dot-com crash, 50% during the great financial crisis, and 21% before the COVID recession. It has plummeted by 33% since 2022, and logically, it signals a weak labor market and potentially a recession. Remember that it's not the absolute value that matters the most, rather, it is the rate of change. So, even though the current number of job openings is higher than pre-COVID levels, the negative rate of change in the growth rate is what matters as far as economic contraction is concerned. And the last chart that we are going to look at today is the total non-farm job quits. This chart is eerily similar to the job openings chart. It went up higher during normal environments and plummeted just before the economic contractions. There are two key differences, however. Firstly, unlike job openings, job quits didn't decrease before the COVID recession. And secondly, the current level of job quits is lower than the pre-pandemic levels. Contrary to popular belief, when job quits go down, it means that the labor market is weak. The reason is quite simple and logical. When the unemployment rate is very low, employees rule the labor market, and they can quit their jobs while being confident that they can find a new job. Hence, during good times, job quits tend to increase. Conversely, when the unemployment rate goes up, employers start to rule the labor market, and employees do not quit their jobs even though they want to, because they know that they may find it difficult to find a new job. To put things into perspective, job quits went down by 32, 49, and 45% during the dot-com crash, the great financial crisis, and the pandemic recession respectively. Lo and behold, it has already plummeted from the highs of 2022 by 27%. And as mentioned a few minutes ago, it currently sits below the pre-pandemic levels, which is very concerning. In sum then, the key labor indicators do not indicate anything good. In fact, as we saw today, most of them have great predictive accuracy and they suggest to us that a recession is not only possible, but likely. It doesn't necessarily mean that there will be a recession in 2024. However, saying that there will be no recession is effectively the same as saying that this time is different. To put it another way, saying that the Fed will engineer a soft landing and there would be no recession is effectively the same as betting against all the indicators that we covered today. Remember that all of the covered indicators have very accurate predictive performance. Not to mention the fact that unemployment rate has 100% accuracy with no type 1 or type 2 errors. So please bet wisely and rely more on data than emotions. A recession is not the end, it is the new beginning. It is a mandatory part of a business cycle that is responsible for all the progress in humanity. Perhaps that's a topic for another video. That was it for today. Thank you for tuning in. Did you find it interesting and informative? Let us know in the comment section. Please like the video and subscribe to the channel so that you don't miss the next part. Have a great day and I'll see you next time.